Good morning, everybody. Kirk Spano here from Arizona. And I was going to record from a golf course, basically, from a deck outside of a golf course, but the haboob came in and started to get us. I presume that you can hear me, so I saw a chat pop up. If you can't hear me, that would be horrible, but I'm going to presume you can. And sitting outside, and I thought I'd have a nice background for you. This is pretty nice. It's a nice office here. And I wanted to talk about a couple of things today that are basically in line with what was the State of the Union. So on the State of the Union, the president talked about Ukraine, obviously. Then he mentioned 3 stocks that are on our top lists, as well as mentioning the opiate crisis, which we have a stock for. And so I'm just going to go through a couple of things with regard to that. Sorry for the weird setup today. My laptop, I think, got a bunch of dust in it sitting outside. So I'm going to have to figure that out. In any case, one of the things that I want you to think about, and this is important in regard to how you construct your portfolio, is I talk about don't invest in the middle of the market. And maybe I don't say it enough. I know the folks that have been with me a while have heard me say it over and over again. And it's important for you to buy into the notion that good isn't good enough when you're buying stocks. The investment barbell that we have with the technology related and new economy and sustainability on the one side, and then the more hard assets on the other side, basically in an 80-20 mix for most people, is important to stick to. And if a company or an industry is just okay, there's no point in buying individual stocks that have that type of a profile. Single stock risk means that you are owning an asset that could conceivably go down 50%, 80%, 90%, or go to zero. There's no point in taking single stock risk if you don't have the potential to go up many, many times more than the S&P 500. You can invest in the S&P 500 or QQQ or any other index, the Wilshire, if you'd like, and you can get what is by definition an average rate of return, around 10% over time. It doesn't make sense for you to go out and buy high yield dividend stocks that have a 7 or 8 or 9 or 10% dividend just because, hey, it's a high dividend and I love that. The problem with high dividends is usually that comes with a lot of risk. You don't want to take a lot of risk. If you're going to take the average amount of risk, again, use the index. If you're going to try to make more than the index, try to get average risk. That makes sense? So think this through. In the continuum, you have below average risk, and above average risk. And then you have outright speculative. There are very few stocks that are low risk. You got your Microsoft, your Apple, your Google. These are stocks that have almost no chance of going to zero. For other companies, you're generally looking at average risk. Most companies, in fact, you're looking at about average risk. They have betas that are close to 1, 0.9, 1, 1.1, something like that. For those average risk stocks, it makes sense to own them if the potential gains are far ahead of the index. So anything that has the potential to beat the market by 1 or 2 or 3%, something at the margins you think can beat the market by 1, 2, 3%, but it has roughly average risk, do not buy it. Don't. Say no. 4 out of 5 stocks you should say no to. And the reason is they just don't have enough upside. So if you're going to take average risk, you want to be able to beat the market by at least 5 points on average, but really 10 to 15 points on average. That's what gets you to that average rate of return that's 20% plus. It's very doable. but you have to be highly selective. You have to buy when there's panic, and you have to buy when people don't recognize the inherent growth and or value inside of a particular company. The way to find that unrecognized growth and value is look for parts of a business that have not been valued. For example, Intel. Here's a stock that the president mentioned by name. I was going to tell you a little story here. Back in 2009, President Obama in February, I believe it might have been his inaugural address, but it was in February 2009, I believe. He said, look, if I could buy stocks right now, I would. When the president of the United States says something, and it doesn't matter what president it is, if he says, look, you should be buying this asset right now, I guess I can think of one exception to this rule. You should be thinking about buying that asset. When President Obama said I'd be buying stocks right now, the stock market bottomed about 3-4 weeks later, and then went on a massive rally. I made 90% in 2009 because in February and March, I started buying stocks, which turned out to be the absolute bottom. Got a little bit above the bottom and then right at the bottom. Right now, you're seeing an opportunity to buy certain stocks near local bottoms. What is a local bottom? Probably a shorter term bottom, but maybe a long-term bottom. And a lot of the SPACs right now, if you are risk tolerant enough to own small cap stocks, the SPACs are probably all going to outperform over the next 3, 4, 5 years. They're cash rich. They have very viable business models. They wouldn't have gotten PIPE investors if they didn't. And the stock prices have come down to below, not at, but below where the dilution would have indicated. So mathematically, the SPACs across the board are cheap. Your job, when something that's priced in a way that it looks like it might go bankrupt, is to ask only one question: will it? So if you can find SPACs that are priced at $2 and $3 and $4 and $5 and $6 a share, and they're not SPACs anymore, now they're just operating companies, and say, okay, this company is priced as if it's going to oblivion. Is it? If the answer is no, buy a basket of those stocks. I own a dozen small cap stocks right now. I think 9 or 10 of them are former SPACs. I'm very happy with all of them. Am I down? Yeah, I'm way down. Down 30 some odd percent, I think, in the last year. Don't care. I don't care. That 10, 12, 20% of the portfolio, depending on who I'm managing for, is down 30%. Big deal. It's not important. If you're truly a long-term investor, you're trying to get the future $10 billion company when it's valued at 3, 4, 500 million. Those are 10 and 20 baggers waiting to happen. So that's on the small cap side of the equation. The mid cap stocks have started to come down, and the large cap stocks have started to come down. We're seeing PayPal, Square, and a bunch of other companies at prices that we haven't seen in 3-4 years. We're seeing a relative strength index oversold on the weekly and, in many cases, the monthly charts. The one thing that we know about monthly charts is that if they're oversold and a company isn't going to go out of business, that is always a time to buy. Always, 100%. Again, all you have to do is ask the question, will this company be around in 3, 4, 5 years? In the case of PayPal and Square, which I've been pounding on now for over a month, you're getting opportunities to buy these companies really cheap based on their cash flows, their current assets, without any regard for future growth. As we can see right now in the global currency markets and the global financial system, the United States is still clearly the most powerful economy on the planet and will be in all intents forever. We're going to die someday. I can't tell you what's going to happen in 2050 or 2100. But for the next 30 years, the United States is the cat's pajamas, right? It just is. So don't expect Bitcoin to all of a sudden fuel an anarchist type of revolution. Don't expect libertarians who don't understand libertarianism to somehow dominate the financial scene. Will crypto become more important? Sure. Will the United States introduce some sort of digital dollar? Yes. PayPal and Square are positioned for whatever happens. Even if the libertarian anarchists win, which will probably mean the end of the world in some way, PayPal and Square probably do pretty well. And Coinbase is close. I don't know what price I need to buy Coinbase at, but it's a company that's extremely well positioned for the future of digital contracts, not just cryptocurrency. NFTs are going to be important in the future for physical assets. We're seeing that right now. Ukraine is teaching the world, really is teaching the world what's going to come with the financial system. So I don't know how many more times I can tell you to buy PayPal and Square and sell puts on those, but a week ago, when Square got back up from the 80s all the way up to 120 again, remember I told you to start selling puts when it was a little under 110, 105, something like that. If you had sold those puts, they'd all be profitable, or you'd be getting Square put to you at a net price in the 90s, which is just barely above where it bottomed. I told you a couple days ago, almost a week ago, that Square was going to approach $100 a share again. And here it is at about 105. If you don't own Square and PayPal, either sell a cash secured put today, right now, after we get off this call, or start a very small starter position, 0.5% of your portfolio, maybe even 1% of your portfolio. The reason you don't go bigger than that is because the ETFs that you're going to own, QQQ and whatever else, have positions there. So consider your asset allocation around your ETFs. What within the ETF, what within QQQ and QQQJ do you want to add a little bit more of? So if QQQ ends up being a quarter of your portfolio at some point, which probably it should, and you want to have a little bit more PayPal, a little bit more Square, a little bit more Apple, Google, Amazon, Microsoft, you add 0.5% or 1% positions in there. Generally start with 0.5%, then add again, and then maybe a month or 2 or 3 months later, add again. Here's an example of scaling in for you. Charlie Munger saw that Alibaba got beat up about a year ago. So he took a small itty bitty position. For him, small itty bitty. For us, everything we own. For him, he took a small itty bitty position. It dropped another 30, 40, 50%. He bought more. Dropped another 30, 40, 50%, whatever it did. He bought more. He bought at those very spaced out technical levels and time levels, right? A lot of time elapsed to average in. The problem that the way a lot of you average in is, one, you buy everything at once. Somebody told me that they sold out of New Fortress Energy the other day. I didn't say sell out of New Fortress Energy. I said that I sold about 20% of my position on the spike from 20 to 35, because that gave me a net cost in the teens, and I can just hold on to the rest of it. Scale in, scale out. 2, 3, 4 purchases, 2, 3, 4 sells. It's rare that you want to dump everything at once. Why? Because you want to ride your winners. What if New Fortress Energy, in this example, goes back up to 60? Don't trade full positions. Just don't do it. Even if you have a starter position, don't do it. You at least break the starter position into 2 cells, especially when you have a giant gain like that. This idea that I should sell everything for almost any reason is usually wrong. But selling half, or 2/3, or 1/3, that makes more sense based on the gain that you have and the risk you're willing to take. How much momentum there is to the upside. I will say, on energy assets, what Ukraine is showing us is that sometime in the next year, the world is going to have a lot of different responses to this. We already know that Exxon and Chevron are going to produce 800,000 more barrels a day. Iran is loading something like 100 million barrels on the ships right now in anticipation of a new nuclear deal. And I'm sure you have the rest of OPEC looking at this, this complete what I believe is a miscalculation by Putin as a way to make even more money by producing at higher prices and bigger volumes at the same time. We also know that they know, and many people don't accept this, but it's just the case, is that by about 2026, 27, demand for oil will stop going up. They know this. OPEC knows this. They all know this. The oil majors are telling us. BP put out a report. Total put out a report. Eni put out a report. They all know that demand for oil is going to stop going up about 2027. Let's just put it at 2027. So between now and then, if they can keep the price of oil around 80 and sell a lot of it, that's what they want. They're trying to maximize profits based on where those lines cross. So that's one of the impacts of Ukraine. Another impact is what I talked about with the financial system. Let's just mention what the president said. I'll circle back. When the president says buy stocks, probably should buy stocks. He knows a little bit more than we do. Doesn't matter which one it is, except maybe one. State of the Union, I almost dropped my Coke Zero when President Biden, in a very capitalist moment, said, hey, Ford, Intel, right, are going to be big companies for us. I also talked about the opiate crisis. So, I really think it's important that we think about investments the right way. When he talked about Pfizer, and not only the COVID shots, but the technology platform that I've been telling you about for 2 years. I've told you that the messenger RNA is a big deal. It's going to change medicine. It's going to help them target things. And when this next variant of COVID comes, and we're starting to see different things happening around the world right now, they'll be able to address it pretty quickly. Now, that doesn't mean that people who aren't vaccinated aren't in trouble. I really feel depressed a little bit that I have friends who aren't getting vaccinated, because I know that the way viruses work, and this is a huge wild card for the economy later this year and next year, the way that viruses work is when they spread easily, they don't kill as many people. But when it's harder for them to spread, and with 70, 80% of the people either being vaccinated or having had it already and having some natural immunity, it's going to become more deadly. Smaller pools of spread generally kill more of that pool. So I really feel as if there's a vulnerability to the economy here. But the worst thing is that I'm starting to prepare myself for a friend dying. I've had relatives that are older die, and people I know that are older die. But I think that some of the stories I've heard from teachers who got it, and nurses that got it, and doctors that got it, right? Younger people. And if we get a more deadly strain this year or next year, yeah, we'll be able to come up with a vaccine pretty quick through Moderna and Pfizer, but it's not going to be fast enough for a lot of people. So keep that on your radar. But again, when the president says, hey, Pfizer, Intel, Ford, in a State of the Union speech, think about how rare that is. Those are 3 of our top stocks, very top stocks, like right near the top of my favorite stocks lists. So I would really be looking to get positions in those if you don't have them, or expand those positions. Intel has suddenly become maybe my favorite stock. I went out to the Intel plant yesterday, and I was going to broadcast from there, but it just seemed like it was going to be hard to do. I put some pictures up in the chat. This Intel plant in Octillo, I believe it's called. I'd have to look it up again, but outside of Chandler, Arizona, near Phoenix, is just enormous, enormous. And the Ford plant that's getting built in Kentucky is something like 6 times bigger, 30 square miles. Pfizer all over the world. And then he talked about the opiate crisis. And I'm not going to mention the name of the stock here because I want you all to make sure you own it. But you need to own our painkiller stock, the stock that is designed to replace opiates. Think about how big Purdue Pharmaceuticals got selling Oxycontin. This company can get huge. And it's down to about $5 or $6 a share. Buy it. Get a couple shares, get a starter position. Stop saying, well, what if it goes to 3? If it goes to 3, then you'll buy more. You know why? Because you scaled in slow. You need to get over these fears and these emotions. Use limit orders. Space them out. Big price differences. So that when the market opens limit down and you have 5 minutes to buy this stock at a super low price, you get it because you already told the computer you want it. I want Square when it hits 100 or 90 or 80. Or I want it at 100 and at 80. Or I want to hit at 100 and I want to sell a put. So I really want you to stop thinking like the market. That's an article that I started and never finished, and I'll maybe finish it on this trip, but I'll for sure finish it when I get home. I'll leave you with this. If you want to beat the market, stop thinking like the market. Pretty easy, right? Nah, it's hard. Because sometimes you have to do things that are scary. Sometimes you have to do things that are out of step. Now, normally you want to actually move with the market most of the time. But there are times when the market is irrationally exuberant and you want to trim into that heavily, like you should have been doing basically the second half of last year. Right? I thought that COVID was going to have a bigger impact than it did in the short term. There was a flood of money from the Fed. We got a bigger rally than I expected. But by September of 2020, I was backing off on getting invested. I was like, well, okay, now let's put some money to work here because all this Fed money is making a difference. But then valuations got so high in the second half of last year, it didn't make sense to ride it anymore. Started selling a lot of things. Got up to 50, 60% cash. I'm down to like 30% cash now, maybe a little under. Because I'm buying on this Ukraine crisis. Why? It's not going to last forever. The inflation is transitory in the sense that it's not going to last a decade. The year-over-year comps get very hard to show inflation by autumn. What does that mean? That means if the price level is here, the price level has to go up even more. Now, you're not going to see prices come down in most things. Oil is going to come down a little bit at some point. Eventually, it'll get lower and lower and lower, and that'll be a disinflationary force on the economy once that starts to happen. And that will happen is EVs sell more, and companies and countries panic pump. And they will, because they don't want stranded assets. I can't tell you exactly when that's going to happen. But with Chevron and Exxon adding 800,000 barrels in less than a year per day, you'd think that we're getting close to that. And oil is over half of the inflation. Supply chains are the other half. Look at the pictures in the chat from Intel. semiconductor supply chain. It's one of the biggest things in the supply chain part of the equation. We're going to have inflation down around 3% by the end of this year. It's going to happen. And by next year, probably be in the twos again. Price levels won't come down, but they'll basically stop going up. And people who are able to negotiate higher paying jobs, their wages will be fairly sticky. So for them, it'll be pretty good. All right, I'm on a phone right now, so it's going to be tough for me to take any questions. But if you pop them up here really quick, I can see that the chat pops up on the bottom of my phone every couple seconds. What kind of questions do you have? I'll be in Arizona until next weekend, so I can meet up with people through next Sunday. Gilbert Avenue is probably where I suggest that we do it. So if you want to email me, go ahead. Happy to meet up and grab a beer. So people ask about MAXR. Is that Maxer? What were they called again? Our space stocks. No, my space stocks are the ones that are on my list. Trying to pull that up. I'm not on a computer right now, so you have to give me more on that. Are they called Maxion? Is that what they are? I know who they are, but they're not cheap. Which specs do I consider the strongest? Yeah, that's the article that I'm writing for Monday. So the satellite stocks are the four that I've mentioned before. I don't want to put them out here in the World Wide Web again. I'll save that for an article, but it's the same four, and you should buy them as a basket. I don't want the rocket ship companies. We're already seeing the government start to limit them. And then AST Space Mobile, that's speculative, but if their technology works, I mean, it's potential 50 times stock or 100. I mean, it's just, the upside is unbelievable. One thing I did want to talk about was the EMQQ and FMQQ for the emerging markets. My order on EMQQ is $30. And over the weekend, I'm going to think about lowering it. But I think that a very small position in EMQQ at 30 is probably worthwhile. I don't know what it's trading at this very particular moment. I can try to pull that up. I know it was like 35 yesterday. So 32, 38. Yeah. I think my 30 is going to hit. So I would put it down at 30. But if you get it at 32, I don't think you should be brokenhearted. FMQQ, if you don't want the China stocks, you know, that one was also very close to our bottom fishing price. And there's a couple others that are out there that I like. The problem with FMQQ is there's like no assets in it. So I'll find another frontier stock or another emerging market basket. The reason we want the tech basket is just because it performs the most. So yeah, we probably need another alternative there. There aren't a lot of great emerging markets baskets out there, managed or otherwise. Just like there's not a really good real estate mutual fund or ETF out there. Just like with real estate, you kind of need to buy the individual REITs. With emerging markets, you know, we have 3 emerging market stocks in our basket, four emerging market stocks in our basket. So I think that owning just tiny positions in those emerging market stocks, right? Just skip your stone across that basket. And I think that you're probably going to be okay if you overlay that against a small position in an emerging markets ETF. You know, one of the things that I just want to remind you about is typically when you want to get into an industry or sector or theme, buy an ETF as a base position and then add the stocks around it that you want to overweight it. So just like with QQQ, you might add a little PayPal, a little Square, Alibaba, Google, right? Amazon, Microsoft. And with emerging markets, you might buy a little bit of EMQQ and then add our basket of emerging market stocks, right? A couple stocks from India, a stock from Brazil, stock from Africa. We have those. And it's about having a good asset allocation, but then giving yourself the ability to crush the market with a handful of stocks that'll probably either trace, their appropriate index or outperform a lot. And that's really what we want, right? We want to outperform a lot if we can. But if we can take average market risk with a lot of upside against the index, we're going to do pretty good. And then you'll have your handful of stocks like Microsoft, Google, and Apple that are among the very few low risk stocks. There's not a lot of low risk stocks, right? So somebody asked about ARK, and my bottom fishing was what, 62? And I said that back when it was like 150 or something. Well, I woke up one morning last week and I owned ARK because I had an order in at 62 and it opened up at 57. I'm not selling it because it's a small position and I like the basket of stocks. I will say from here on out, I am much more likely to buy stocks myself than add more ARK. ARK is down to 60.73, so I'm only up about $3 on it. I am much more likely, because I don't think she's a great trader, right? I don't think Kathy Wood is a great trader, and I think she's constrained by the rules of ETFs. So since I have that little starter position in ARK, I probably won't sell it for a very long time, up or down, but I will cherry pick my favorite stocks out of that basket. And you know what some of them are. So when you build your asset allocation, say, okay, these are the 4 or 5 or 6 ETFs that I want to own eventually. And then these are the 4, 5, 6 stocks that I want to buy in addition to the ETF that are within the same, part of my theme, my investment asset allocation. And if you do that half a dozen times, you're going to kick the shit out of the market. You just are. Because every one of you is an above average investor if you systematize how you're doing things. And I know there's some of you who you still get the yips. I need you to erase in your head a lot of the things that you do. Get rid of the confirmation bias. Get rid of the recency bias. And start being more systematic. I mean, ultimately, I'm a very systematic investor. And when I showed you charts a year ago of how low stocks could go, I got laughed at. And now a lot of those bottom fishing prices, the buy zones we're in and the bottom fishing prices are right on top of us. This is when you want to buy. This isn't when you want to ask how much lower it can go. This is when you're like, okay, how do I start scaling in? Somebody asks, is Russia trapped in Ukraine for an extended period of time? What do I think China's going to learn from this? I think that Vladimir Putin, little Vladdy, is about to get spanked. Not only by the allies, by NATO and Ukraine, but by his own people. And in particular, I think the oligarchs are going to get rid of him. Putin's grasp on the military is tenuous at best. The FSB is powerful. The oligarchs are powerful. Putin has almost no way to leverage himself over all these people who are getting angry with him. I don't even think he can launch nuclear weapons at this point. When oligarchs in the press are basically saying no war, but they don't mention Putin by name because they don't want to get, poisoned. The writing's on the wall. It wouldn't surprise me if Russia is out of the Ukraine within 90 days. And it wouldn't surprise me if the Ukraine makes some minor concessions, the main one being no missiles in the Ukraine, right? No intermediate range missiles in the Ukraine. And then Vladdy can back up if they haven't got rid of him by then. Vladdy can back up. I mean, this idea that he's trying to capture the wheat production and some of the resources wealth of the Ukraine, it's not worth the cost. The Ukrainians are never going to stop harassing him, ever. Ever. He knows that. And if he doesn't know that, it's just another reason for the oligarchs and the people to get rid of him. This is going to work out. It'll be fine. China is learning that, and remember, China has more to lose than Russia. China is learning that the West can basically cancel somebody. Russia's getting canceled right now, right? This is cancel culture hitting politics. China doesn't want that. They need the exports. So I think that this little escapade, I think it's going to make China very wary of going into Taiwan. They're going to negotiate. So, all right, I'm going to call it a day. This is recorded on the cloud, so I will get this posted in the morning with probably no edits at all. I'm going to Talking Stick Casino right now to play in a tournament, and I'm going to pretend that I don't know how to play. So no baseball cap, no sunglasses. I'm going to ask a lot of questions. How many people do you get at this tournament? Wow, this is pretty cool. 100 people here at $125? Wow, that's $10,000. So we'll act dumb until they figure it out. In any case, take a look at this market. Try to find places to get starter positions that are in our top 10 list that I put out the last couple of weeks, top 10 dividends. Tell you what, you have got to own Intel and Ford and Pfizer and the opiate company. They have to. If you don't, I don't know why you wouldn't. Those are probably, after Apple and Microsoft, the next three best dividend growth stocks in the world. Somebody asked about solar stocks and solar inverter stocks. So that's one of the baskets that I would talk about. You're going to want to own either PBW or QClean as your core clean energy position. And then you want to add about a half a dozen stocks around it. And the solar inverter stocks, I want both of them. I might buy Generac if it pulls back enough, because they have a pretty unique approach to that market. And then there are three solar stocks that I like as well. You know what two of them are, but I'm going to add another one that was first on my list a long time ago. There's a hint, right? It was first on my list a long time ago. So there's a half a dozen solar stocks on top of an ETF. And I think that should be a pretty common approach for you, is an ETF and then about a half a dozen stocks in that area. All right. Have a great weekend. I will have a few articles out for Monday. I'll post them as I go on Sunday. And I think that you're going to get a little bit of a pullback here, right? That rebound rally. Hey, speaking of rebounds and magic formulas and things, I think it's just interesting that people talk about their magic formulas and they basically belittle other investors when they talk about their magic formulas. And the reality is that they're not given great time frames. I think when somebody tells you a year ahead of time, this is about how things are going to shake out, you say, well, your orange box is way too low. I can't imagine getting to the top of that box, much less the bottom. And then about a year later, it's happened. I think that's more magical than somebody else's magic formula where they talk about how sentiment rules the market. Well, of course, sentiment rules the market. Jesus Christ. But that's in the short term. Buffett talked about that. In the short term, the market is a popularity contest. In the long term, it's a weighing machine. I'm really good at telling you what's going to win a few years out. I wouldn't have 20 10 baggers if I didn't. 24 10 baggers if I didn't. I wouldn't have told you about Ford when it was $5 a share. Right? I wouldn't have told you about Intel a couple of years ago when it was 30 something. Or Pfizer. Be a futurist when you invest. Look a couple of years into the future, not a couple of years into the past. And you will find big winners. You don't have to take a lot of risk to do it. Just stack up the catalysts. Company A is valued at 100 based on what the market sees right now. But there's 2 or 3 other things with company A. Or should we call them company T? Right? Look for catalysts, things that the market hasn't valued. This is something that Buffett and Munger have both said. They look for companies that the market doesn't value parts of the business. Now, how low can Intel and Ford and Pfizer go? Not much lower. And then they'll rise and then they'll come back down. And I don't know if they're going to have 3 successive lows or only 2. Or will it be something weird and they'll have a cascading falling price and go down, another 30 or 40%. If they do, I'll buy more. But at some point, you have to realize that the Fed is probably not going to be as hawkish as the estimates from before Ukraine. And Ukraine doesn't even have anything to do with it. I wrote that article a few weeks ago. The Fed doesn't want real interest rates to be above 0. So inflation minus the interest rate, they want that to be around 0. Or a -1. That's what they want. Because then it doesn't cost the government any money to finance. When people come out, when these Austrian investors come out, when these Austrian economists come out, and they talk about how the dollar is getting weakened, which they've been doing for a decade, since I said it was going to go up, who's been right? The dollar just goes up and up and up. It's because the American economy is that strong and that pervasive. If you've traveled, you know this. Everybody in the world will take $1 from you. Everybody. There's a reason for that. We're the most trustworthy large economy. Now, you might say, really? Well, do you trust Russia anymore? Do you trust China? The EU is probably second, but you always worry about them breaking up. The United States, at a quarter of the global economy and way more of the financial system, is the most trustworthy, strong, big economy on the planet. Dollar ain't going anywhere. So everything should be looked at in that prism. Everything. And Tom Lee is probably right. I'm glad that he agrees with me. After this shakeout, we might see an even longer bull market than the one that we just had. The 2009 to the 2018 bull market, right? 10 years. And then it's been choppy since, even though it's higher. When we get back to 2018 prices and maybe 2016 prices, whichever one we get to, and they're not that far apart, we're going to start another very long-term bull market. They'll be interrupted by something that, we have to fix from the baby boomer retirement. But, man, I'm super bullish over the next 15 years, give or take. As we rebuild the economy, as we become more sustainable, as work becomes more fulfilling and flexible, I just think it's pretty amazing. All right, everybody, take care.